Hello and welcome. Today, we're going to try and make sense of something really strange that's happening in the financial markets. We're seeing a situation where all the numbers seem to be pointing up, but the actual mood on Wall Street, well, that's telling a very, very different story. So the date is October 27th, 2025. And if you just glanced at the US market, you'd think everything was fantastic. We're seeing a really powerful rally, with the major indexes hitting record highs. But if you look just beneath the surface, there's this feeling of, well, caution, almost fear. So how is that possible? How can the market be soaring when the people who drive it are so nervous? And this slide really lays out the central conflict, doesn't it? On one side, you have the market's mood, at least on paper, which looks incredible. The S&P 500 is just crushing it. But then you look at the institutional reality, and what you see is the complete opposite. Big money investor sentiment is stuck deep in the fear zone. So which one is telling the real story? To figure that out, here's how we're going to break it down. We'll start with this tale of two markets and really define the core conflict. Then we'll dig into the three big reasons why there's so much fear. After that, we'll look at some key data, explore three possible scenarios for what happens next, and wrap it all up with the final takeaway and the biggest risks to watch. So let's start with this idea of a tale of two markets. It's a phrase you hear a lot on Wall Street, but this time there's a really confusing twist to it. You've probably heard that old saying, the market climbs a wall of worry. It basically means that stocks can go up even when people are pessimistic. And yeah, that's what's happening. But here's the difference. Right now, it feels like the foundation of that wall is actually starting to crack. See, this rally isn't being led by a flood of new, optimistic buyers. The big institutional investors, the ones who usually lead a charge like this, they're actually pulling back. Okay, so let's really dig into that core conflict. I want to show you the hard data that proves this bizarre disconnect between the price you see on the screen and the sentiment behind the scenes. And here it is, plain as day. This is the CNN Fear and Greed Index. It's a really popular tool for measuring market sentiment. And just look at it. Even as the S&P 500 is rocketing to new highs, the needle on this index is stuck firmly in fear. This isn't just a feeling, it's a measurable, visible gap between what the market is doing and how investors are feeling. So the big question is, why? Why are the professionals so spooked while prices are going through the roof? And that brings us to the real heart of our explainer today, the three main reasons for all this fear. All right, the first reason is a little technical, but it is absolutely essential to understanding what's going on. It's all about something called short covering. Now, when someone shorts a stock, they're betting that its price will fall. But to close out that bet, they have to buy the stock back. So, a huge chunk of the buying pressure we're seeing right now, it's not coming from people who believe in the market. It's coming from people who bet against the market, were wrong, and are now being forced to buy stocks to stop their losses. It's panicked buying, not confident buying. And this isn't just a theory. Top firms have confirmed, but this rally is being driven by that kind of forced buying. But here's the kicker. At the very same time, these big hedge funds are actually reducing their net leverage. That's just a fancy way of saying they're lowering their total risk. Think about that for a second. As prices are going up, the biggest players are quietly and cautiously taking their chips off the table. They're participating, but they're not happy about it. Okay, the second big reason for fear boils down to a single number, 52%. That's the percentage of S&P 500 companies that are seeing their earnings forecasts revised upward. Now, you might think, hey, 52% is more than half, that's not so bad. But it's the direction that number is headed that has everyone so worried. This is exactly why analysts like Lori Colvacina at RBC Capital Markets are saying this situation makes them nervous. You see, that 52% number, it was recently up over 60%. A drop that fast is a huge red flag. It tells you that the optimism about how much money companies are going to make in the future is fading, and it's fading fast. So what this all means is that the fundamental ground underneath this rally is getting really shaky. Corporate earnings aren't looking as good as they were. Valuations are starting to look stretched pretty much everywhere, not just in those high-flying tech names. And the whole market is being held up by just a handful of giant companies, while the smaller guys are actually seeing their outlooks turn negative. And a third major reason for all this fear is just the big picture, the macro uncertainty. We've got a government shutdown that's been going on for 27 days. That means the Federal Reserve is basically flying blind, making huge decisions without the economic data it relies on. On top of that, there's a real risk that the market has gotten way too excited about future interest rate cuts. And let's not forget, those high tariffs on Chinese goods are still in place. These are massive, unresolved issues that make it really tough to bet on the future with any confidence. All right, now let's pop the hood and take a closer look at some of the key data. We'll focus on a major global issue and the really deep cracks we're seeing inside the market itself. You know, this government shutdown, it's so much more than just a political headline. It's a genuine global economic issue. The U.S. Federal Reserve is, without a doubt, the most important central bank in the world. And right now, it's operating in a data vacuum. It doesn't have the official numbers on inflation or jobs that it needs to make smart decisions. That creates a huge amount of uncertainty that sends ripples through every single market on the planet. And this table here just perfectly illustrates the market's split personality. On the one hand, you have the Magnificent Seven, those giant tech stocks. They've got strong momentum and positive earnings revisions, though even they are slowing down. But then you look at the Russell 2000, which is made up of smaller companies, and it's a totally different world. Weak momentum, negative earnings revisions. It's not one healthy market. It's two markets under one roof, with a few giants holding up a foundation that's getting weaker by the day. So, with this weird, conflicted market setup, the obvious question is, where do we go from here? Let's walk through 3 potential scenarios for what could happen next. First up is what's called the melt-up. This is where the fear of missing out, or FOMO, becomes so strong that all those cautious investors on the sidelines are finally forced to jump in, pushing prices even higher. The second possibility is the fundamental correction. This is where gravity finally kicks in and those weak earnings and high prices lead to a pretty significant drop. And third, you could get a volatile sideways market, where the buyers and sellers basically fight to a draw, and the market just chops around without going anywhere special. Okay, let's pull all of this together now. What's the final takeaway, and what are the most important risks that investors really need to be thinking about right now? So here it is, the big takeaway. This rally we're seeing is incredibly fragile. But, and this is the paradox, the very same fear that's making institutions nervous has also created a giant pile of cash just sitting on the sidelines. If something causes sentiment to flip, all that cash could pour into the market and become the fuel for that melt-up scenario we just talked about. So in a really strange way, the market's biggest weakness right now could also be its biggest potential strength. So what should you really be focused on? It comes down to 2 core risks. First is overvaluation risk. Simply put, prices are high, and the earnings that are supposed to support them are getting weaker. That leaves almost no room for mistakes. And second is macro and policy risk. With the Fed flying blind because of the shutdown, there's a real chance they make a policy mistake that could seriously shock the market. And all of this leaves us with one final big question. Is this market really climbing that classic wall of worry with plenty of room to run higher as all the doubters get pulled in? Or is this whole rally just walking on incredibly thin ice, ready to crack the moment something goes wrong? That is the paradox right at the heart of the market today. Thanks for joining us.